The Rebel Capitalist Show.
Let's just assume that China goes into a recession. You said you're actually, before we get there, Keith, why are you bearish on China longer term? Let's start there and then kind of work backwards.
It's the easiest short since Japan. I mean, which was a pretty easy short. Or in the case of JGBs, a great bull case for JGBs. Remember how many years, George? People were like, "Oh, you gotta short those JGBs. They're at a valuation that's unsustainable."
Didn't they call that the Widowmaker trade? Isn't that the Widowmaker? I think so.
But the number one reason to be short Japan over the years, I'm talking about 30 years, was demographics. So you have two big reasons to keep this simple on short China. One, on the industrial side, or old China. They peaked after they entered the WTO and big time and have been slowing ever since. You've had industrial production rally cyclically, which is what rallies in a downward sloping long-term line. So when you take a 3 to 6 to 10 year view on China from here, there's a very high probability that their industrial growth decelerates at a faster rate. That's the old China. On new China, the demographics are the worst in the world. I mean, the one-child policy is coming home to roost. The propensity of the consumer to consume, i.e. their capacity to consume, their demand to consume, is going down as the population ages. If you look at, the 35 to 55-year-olds are your biggest spenders in an economy because they got kids, they got all the bills. And that cohort is slowing big time to negative year-over-year growth as well. So when you have both the old part of the economy, or the cyclical part of the economy, and the consumer part of the economy slowing, and the government's going to regulate your ass like they're doing right now, it's just not good.
Yeah. So my thought process when you outline that is China having less consumer demand, therefore they're importing less. Now, we all know China's a huge exporter, but no one really talks about how much they import. And according to my research, they import about $2 trillion worth of stuff every single year. So if they're importing less stuff, the majority of that stuff is settled in dollars. So therefore, fewer dollars are going outside of Japan. Then I'm thinking about the global dollar-denominated debt. And then I'm thinking, okay, with those dollar-denominated cash flows reduced significantly, now all of a sudden, if you're a corporate entity in Colombia, let's say, you don't have as much dollar cash flow. So you've got to take your peso cash flow and sell those pesos to get the dollars you need to pay down the dollar denominated debt. And now all of a sudden you have a lot more demand for dollars, a lot more supply of these other currencies, which could maybe add another tailwind to what you were saying with the dollar going down to 90, but then starting to go back up to, who knows,
105.
We could get up to 100 again.
Yeah, I think so. I mean, anytime you have the key, I think one of the keys to what you just said, the fulcrum point, is the debt, right? The debt is the fulcrum point.
Yeah.
The debt is going to be deflated in dollars cyclically. It doesn't have to be deflated on the timeline that somebody writes a book about it or wants to be famous about it or whatever. That's not what markets do. The fact of the matter is the biggest deflationary scares that we've had have been defined explicitly by a shortage of dollars and dollar denominated debt. That's right on the screws, right? And it doesn't matter till it starts to matter. Currently, dollars, I mean, think about it like to your point in euros, almost 60% of the US dollar index is indeed the euro. And the European economy is going to rip in the next 2 quarters. Like, don't forget that they delayed their reopening more so than we did, and they had more regulation.
Yeah, I remember hearing you say that you are bullish on the European market.
Right. So I do think that Europe's going to be a lot stronger than people think. In fact, like our fourth quarter GDP numbers, almost, the Atlanta Fed's at like 3.5% growth. We're at 6 going towards 7. But in Europe, like we're already at 6. We have European growth going from basically 2 to 4 to 6, almost 7% GDP growth in the next 2 quarters. And most people are like, this is Europe. How's that possible? Well, we'll see. And that would be bullish for that'd be bullish for the euro.
Right. So that's why short term dollar going down maybe, but then longer term that starts to settle down. They get that 6% growth rate, then it goes down back down to
then
4, maybe 3. Then you have all the structural issues kick in, which then tilts the boat in favor of the dollar again. Yeah,
that's so if you stay on my timeline and you fully load up what you said about US dollar denominated debt, and we go to the second quarter of next year and the euro is coming off like a material level, like 141, 142, a level that it's had a hard time sustaining anyway from a mean reversion perspective. And then the euro starts going down because Europe slows off its cycle peak. There's another reason why the dollar can go up.